My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now.
Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people want to make friends, but just trying to make you some money. My job is not just to entertain, but to educate and teach you. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. Now that big business has rediscovered the urge to merge, it's worth remembering some things here. Just because a deal makes sense, that doesn't mean it'll get done. And just because a deal gets done, that doesn't mean it'll make sense. After a muted session where the Dow finished flat, S&P advanced 0.07%, Nasdaq declined 0.29%, we need to address merger mania because this market was dominated by deals today, both real and imagined. Before we get into the weeds, let me just lay out my position for you. I love mergers and acquisitions. The more deals we get, the higher the stock market goes. These transactions reduce the supply of stock floating around, and anything that takes out supply is good news, particularly if it's reapplied to buy back new stocks. However, I don't love speculating on mergers and acquisitions, especially when you're acting on a tip. As always, I say tips are for waiters. If you know for sure that a deal is coming, acting on that information is illegal. If you don't know, then you're just gambling. My rule of thumb, never bet on a stock just because of takeover speculation. Only buy the stocks of companies with healthy fundamentals. Then any potential deal activity, well, let's just say that's gravy. Which brings me to today's action. This morning, my squawk on the street partner, David Faber, reported that Xerox wants to buy HP Inc. with a combination of cash and stock. And that was indeed an offer that was confirmed this evening. There's only one problem. Xerox is an $8 billion business. HP is a $29 billion business. Yet, in its current configuration, there's no way that Xerox can pull this off. And it's pretty clear from the statement HP issued this very evening, the offer they got from Xerox is pretty much dead on arrival. However, if HP wanted to buy Xerox, well, that's a horse of a different color. One that investors are obviously thinking about because both stocks rallied today. Either way, this deal makes a ton of sense. Both companies sell into the same channels. If they join forces, they can combine enterprise. Well, it can cherry pick the best salespeople, the same accounts, instant synergy, cut costs. At the moment, HP's personal computing business is thriving, but printers are not so hot. Still, the company has a plan to revive its sales and trim its workforce while generating enough cash flow to maintain that hefty 3.3% yield. But just because a deal makes sense, that doesn't mean it will happen. First, HP just got a new CEO, Enrique Lores, and he probably wants to at least kick the tires of his own enterprise before he makes such a major decision. Second, HP is trying to go for higher growth models, like 3D printing, not more regular old printers, which has become a commodity business. While Xerox has some proprietary businesses of its own, it's mostly got the kind of businesses HP is moving away from. HP wants to be the leader in manufacturing digitization, which is part of Lori's long-term plan that I've looked at, and the one he just revealed. This deal really doesn't further that. Okay, that said, I don't think the transaction's that far-fetched. About a year and a half ago, one of my favorite M&A writers, Ron Orrell, reported that HP tried to buy Xerox in January of 2018. At the time, Xerox was negotiating an exit from its joint venture with Fujifilm, a deal that was just consummated, giving the company $2.3 billion in cash. With that out of the way, I think a takeover is more likely. So what do? I would sell HP into strength. I think it will have trouble hitting its numbers. If you want, you can take those profits and plow them into Xerox. It's got cash, it pays you nearly 2.7% yield, and the stock sells for just 9 times earnings. I see no harm in owning this one. What else? Okay, last night, we started hearing that Walgreens Boots Alliance is thinking about going private. Now, this is a dangerous situation. We have CVS on the show later tonight, fresh off its picture-perfect quarter. They're seeing strength in prescriptions, but also benefiting from CEO Larry Merlo's gutsy decision to acquire Aetna late last year. Why was the Aetna decision such a brilliant move for CVS? Simple. Buying a managed care company helped them diversify away from the tepid sales at the front of the drugstore. It's the front of the store that's under direct competition with the retail Death Star that is Amazon. I bring this up because Walgreens doesn't have that kind of protection. It's pretty much a pure play, old-fashioned drugstore chain, which isn't enough to fend off the online poachers. Remember, they have better prices. I mean, it's out there. Yet another big store, but with not a lot of special features or special prices versus something like a Costco or Walmart, to say nothing of Amazon. And so now we are hearing that Walgreens might take itself private. Are you kidding me? They'd be doubling down on exactly the part of business that's getting hammered there. I can think of worse decisions but not many. Of course, anything's possible. Companies do stupid things all the time. GE did about 4 in a row. But if you're buying Walgreens here, betting it will be taken private, don't hold your breath, please. I say swap out of Walgreens and swap into CVS. Finally, there's Tiffany, the jewelry store chain. One of the best-run companies in the world, LVMH, wants to buy Tiffany, but they want to buy it on the cheap, somewhere around its current price of $124, roughly $15 billion. Let me be very clear. That's not going to happen. Don't get me wrong. I think it would make a ton of sense. This merger makes it's crystal clear that they should do it. Tiffany needs to be part of a larger enterprise. Tiffany, the brand, is worth a heck of a lot more than Tiffany, the brick-and-mortar retailer. I've been very impressed by CEO Alessandro Bogliolo. And if you haven't seen some of the new designs, I think you're missing out. That's a terrific reason to go to their stores and do some shopping. But it's not much of a reason for Tiffany to be a standalone outfit. Plus, nobody knows luxury like LVMH. They're to luxury as the New England Patriots are to football. To belabor the metaphor, Tiffany's a very good wide receiver, something for Tom Brady to hit to spread the ball around. It won't be able to close all the stores to diversify from its U.S. anchor on its own, though. The task is too big for Tiffany to do alone. So it would make a ton of sense for Tiffany to get bought by LVMH as long as LVMH offers a reasonable price, meaning a decent premium to where the stock's currently trading. I hope they can make a deal because it's worth a great deal to both shareholders. Tiffany's got to see the light here, and LVMH has to, too. Again, I'm pro-merger because mergers reduce the amount of supply out there. Lower supply, higher prices. We hate excess supply. Classic example today, the lockup on insider selling in Uber expired, causing more than 1 billion shares to be released. This stock's been a disaster. But if Uber could offload its Uber Eats delivery business to, say, Grubhub or DoorDash, I think its stock would make a beeline from 26 to 36. And the stock of the acquirer would also roar, too. Why? Well, DoorDash is private, but you know what I mean. Because there are too many companies in this particular delivery space. Too much competition. Anything that takes out a rival will benefit the entire industry. You know what else needs consolidation? I mean, how about all these cloud-based marketing companies or the cloud-based cybersecurity companies? We need some massive mergers to get those stocks going. Oh, and I happen to like the First Horizon Iberia Bank tie-up in the regional bank space. We're going to hear from that later, but that's a very good example of 2 plus 2 conceivably making 5. The bottom line, while mergers can be fantastic if you own stocks, they're miserable if you own the stocks of poorly performing companies where you'll be left holding the bag if nothing happens. So enjoy the fact that we're starting to hear deal chatter again, but don't feel compelled to speculate on these potential deals. For the most part, that's a mug's game. Ryan in Alabama. Ryan.
Hey, how you doing, Jim?
I'm doing well, Ryan. How about you?
I'm doing good. So I got a question about Tailored Brands. So they're selling one of their corporate apparel lines and one of their 2 Canadian distribution centers to lower their debt. And they're talking about cutting their dividend and using that money to potentially do a share buyback program. With all this in consideration, do you think there's any more upside to the stock in the near future?
Well, Brian, we got to be candid with each other here. I think that Tailored Brands is one of those dying brands. Now, maybe it can bounce, but the fact is that I even struggle to try to figure out why to recommend VF Corp right here. I happen to like Columbia. They're terrific. And my condolences to Mr. Boyle for losing his terrific mom. But I do not want to recommend anything in that apparel sector right now other than perhaps a Nike or Columbia. Let's go to Gregory in California. Gregory.
Good day to you, kind sir. How are you?
I'm good. How about you?
I'm doing okay. I can't complain in the California sun. But one of my favorite stocks that I talked to you about some time ago really got spooked on Halloween. It was a pretty terrifying October 31st earnings report for Mercado Libre. And I bought in the mid-500s. It dropped $80, and it's dropped some more since then. So I wanted to talk to you about that and see if I should consolidate, if I should sell it, if I should hang on to it. I did listen to the earnings call, and it seemed like it may just be one of those high-growth flying stocks that got murdered.
I agree with you. Look, I know that there are people who cut the price target. A lot of the analysts are running the other way from it. It's the only game in town down there. And in the end, it's a stock that I think I've liked since it came public. I'm not going to deviate. I'm going to tell people to be in it. Let's go to Joe in Connecticut. Joe.
Hey, Jim. I love your show.
Thank you, Joe.
You are the Jack Bogle individual stocks.
Jack was an amazing man. Thank you.
So one of your stocks, I think it is one of your favorites, but it's had a little drop lately. I want to see American Tower.
I don't know. I mean, this is just pure profit taking. People didn't want to buy the high growth stocks. American Tower is the classic name, classic growth name. I would buy the stock right here. We need more towers. There's no doubt about it. 5G requires them. I think that this is a very good stock here. We recently had Jim Tacklet on, and I thought, you know what? If this one comes in, buy it. It has. Buy it. All right. There's a plethora of deals roiling the market. Some deals are super, some are miserable. Be careful of what side you're on. On Mad Money today, CVS offered this market a booster shot after reporting an earnings beat. I'm sitting down with the CEO, fresh off the report. Then, should you be hitching a ride with Uber or Lyft in this market? I'm comparing the ride-sharing companies. And First Horizon announced the second biggest bank deal of 2019 this week. I'll find out what it means for the stock and your portfolio when I find out what's on the horizon with the CEO. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.